I'm Keith McCullough, and welcome to another real conversation with a new guy that I'm just getting to know. Actually, right before we came live to you, asking a little bit about your family and your background, but I came to know you and welcome, Dan Rasmussen.
Thank you. It's nice to be here, Keith.
It's a real conversation where try to keep it real. I mean, you write about a lot of real topics, and from the perspective that really resonates with me, from a buy-sider's perspective or a doer's perspective, somebody who's built their own firm and
made their share of mistakes.
Yeah, make tons. Like you only learn by doing. But I mean, yeah. I hadn't met you in person, as you well know, until like 10 minutes ago, and I felt like I'm not supposed to have feelings when I look at data, but when I started reading and you're the kind of guy where people pass around your stuff,
yep.
Right? I think when people pass around my stuff, it's more for other reasons, like maybe they're hating on it or something. But this, really thought-provoking stuff that's really, to some extent, anti-establishment, certainly challenges industry norms or accepted prophecies. And I wonder, is that something? And we'll get into your firm and how you think about investing. But is that something that's just in you as a principal orientation?
Yeah, I think so. I was saying before we got on here that I grew up in a house where my dad, who's a brilliant strategic thinker, he's a lawyer, and I know you're a big hockey guy, but my dad had various schemes that he wanted us all to succeed in. So he said, well, why don't you, to my older brother, why don't you go into figure skating? Because there aren't that many male figure skaters, so how hard could it be to get good at it? And my sister was a female ice hockey player, and then I tried both, wasn't good at either, and so switched to rowing, which anyone who can pull an oar can be good at. So I think that from a very young age, this idea of strategy, of finding different takes, finding places where you can succeed that are, maybe less competitive or where you have a differentiated view, has been something I was just raised on around the dinner table.
It is endemic to us. I mean, to fight, as I like to say, fight the old wall or try to show your own path, but it doesn't always work.
No.
Can you let's just take a step back for people that don't know you either in terms of your background. I mean, you were an intern at Bridgewater. You went to Bain, then you back to Stanford, started your own hedge fund there?
That's right.
And now, since you've had Verdad?
Yes, that's right.
Okay. Can you just walk us through that life path a little bit?
Yeah, so this was my dad again when I was in college, and I was trying to figure out, I studied history and literature. I focused on the 19th century American South and nothing to do with investing.
You wrote a book on it, didn't you?
I wrote a book about a slave revolt in New Orleans. Yeah, it was my senior thesis. And
you're not writing about 200-day moving monkeys. That's interesting.
No, and I talked to my dad. What should I do when I graduate? And he said, I went to law school. I was the top of my class at law school, and the people at the bottom of my class went into finance and Wall Street, and they all made twice as much money as I did and retired 10 years earlier. And we're idiots. So why don't you go do that? Anyway, I think from Dad's perspective, law was a very difficult sport, and business seemed like an easy one from his perspective. So, I mean, I think he's a little out of date on that. But so I ended up applying to a bunch of investing jobs. I got a job at Bridgewater, and I sort of fell in love with the investing game. I mean, I was fascinated. It felt like a place where it was a battle of ideas. It wasn't necessarily about the hours you put in, although you end up putting in a lot of hours, but it was about the quality of your ideas. And I think the other thing that I liked about it was I'm a natural contrarian. I like arguing, I like debating, and it felt like, in finance, every trade is a disagreement. Someone thinks it's going higher, someone thinks they go lower, and they meet in the middle and sell. And so every decision you're making, you're thinking this meta-analytic game. It's not about what you think, it's what you think relative to what that other guy thinks or what the market thinks. And that whole framework was just so appealing to me. And so I ended up, enjoyed my time at Bridgewater, went to Bain Capital Private Equity right after graduation, was there for 4 years, had a really interesting experience. And then, I probably my third or fourth year there, I realized I was just really bad at working for other people. I mean, I tried. I got like an executive coach to try to teach me to be more diplomatic and things like that, because I just found I was pissing people off, and I didn't mean to, but I did, and I couldn't stop it. So I figured, I'm not going to succeed in a bureaucracy because I'm going to piss too many people off or not respect the people I'm working for. Even if I did respect them, but I'll cause trouble. And so I thought, why don't I start my own firm and maybe that'll work, and thank God I did, because I've loved being an entrepreneur.
That's awesome. I mean, and maybe that's why everything you write resonates with me, because our paths aren't dissimilar in the sense that I thought the best job I ever got on Wall Street I was in my early 30s, was the managing director at Carlyle.
Yep.
And once I got there, like it was just this, the bureaucracy of it all, or just it felt like I was back in Canada, maybe even Russia. Like it was just it's just different, where the man's on top of you, and that's the deal.
Yeah.
And there were a lot of them, right? Because there were a lot of senior partners at Bain, Carlyle, et cetera. And I don't think without that experience, I don't think I would understand the opportunity.
Yep.
You know, in my case, to try to tear down the old wall, for example, how I think about it. Like, do you agree with that? Is that something that is almost a must-have in your path?
Absolutely. And I mean, I think it's on the one hand, you look at a bunch of, a huge bureaucracy of people, and you think, wow, the trough here is really big. Like if I just stick it out, I can be eating at the same trough, and life will be pretty good.
A lot of people do that, and there's a lot of money to be made doing that.
Yeah, and no disrespect. I mean, that's a really hard path, but I think it's a different path, right? I mean, for me, I have trouble if I think something keeping my mouth shut. And, I have trouble sucking up to people if I don't really like them or respect them. And I just thought, therefore my navigation of this path is never going to be perfect. And I think there are other people who are just better able to suppress their views, or maybe they just don't have as many views or aren't as prickly. And I have nothing against those people. Just I couldn't do it. It was just impossible. I would have been a failure. Mm-hmm. And I just needed to be somewhere out on my own.
It's again, it's not for everyone, but if you're just being yourself, it's a lot easier to do, right? Yes. But again, I'm not criticizing anybody who stays at a. I mean, these are our clients, right?
Yep.
I mean, these are large firms. It's a hard thing to do for people like us, because there's an irreverence to it. There's also rebellion to it, but there's also truth to it.
Yep.
And there's that. Like one of the best quotes I thought, like in just preparing for this, that Dan has. Listen to this quote: "Investors should be motivated by data, not myths."
Yes.
I mean, first of all, when did you say that?
Yeah, I feel like I say it every day. So not sure I can put a timestamp on it.
I mean, that's. I talk a lot about narrative shift. Or, what's the latest narrative? I look at rate of change data, and you can have somebody immediately tell you the opposite, and that be. Like everybody head nodding, like we got a nodder. You got, especially at a large institution where they'll just accept that as truth.
Yep.
I remember Ed Hyman coming in. You know Ed Hyman, obviously, right? He comes into, we're at Carlyle, the place is on the verge of blowing up. And I'm like, the economy is slowing. That is a rate of change fact. This is in the middle of 2007, right? He just sit there, just looking at everybody else in the room but me and saying it's not. So it's kind of like this, permeable, the bullshit of it all. I was like, wow, that, like when it was all over there, like what an opportunity, like even I can see that opportunity. Talking about the rate of change of reported economic data on a trending basis, using big things like GDP and inflation, that is still subject to myth versus reality. I mean, to me, it's crazy that we live in this AI environment where everyone's going to know the actual truth. But at the same time, nobody wants to actually talk about it.
Yeah, it's not a lot of people's incentives, right? I mean, I think if you're selling a product and you're, let's say you're long tech stocks, there's never going to be a point in which you're not long, right? Or where you're saying, hey, geez, something's going on in the economy that has me get out of that, right? What are you going to tell your clients who got into it over the last 5 years, right? Relationships are sticky and businesses are sticky, and I think there are a lot of incentives, therefore, just to be, pick whatever lane you're in and just keep driving. Mm-hmm. And I can understand that as success criteria, right? I mean, I think a lot of things, right? Investing is hard because sometimes it conflicts with some of the things we know in our personal life, right? I mean, if you said, hey, gee, I've been friends with Bob and he's been horrible to me and he's going bankrupt or near bankrupt, and should I give him money? You'd say absolutely no. And what about the straight A student who's done really well for the last 5 years and killing it? Should I give him money? You'd say yes, absolutely. In stock market, sometimes you want to give money to the stock that looks like it's down and out and it's been terrible for the last 5 years, and the last thing you want to put it into is the thing that everyone likes and respects. So there's, I think, this constant conflict sometimes between the lessons from one's personal life and how that plays out in the business world or in the world of investing.
Yeah, I think you can over and over and over again. I think the analogies are endless. Like every macro show, I'm almost like grabbing the latest.
Right, and I think, to this point, right, I mean, I think someone who puts their head down and works really hard and doesn't get distracted by things around them, right, that's a success path. But sometimes investing, everything's changing so fast, and changing your mind
Yep.
or stopping doing one thing that you've been doing for a while and starting doing something else turns out to be the right answer, which is counterintuitive, I think, to a lot of successful people.
What do you think are some of the greatest myths, or some of the things that annoy you that you want to get in an argument about?
Well, I probably am more well known than anything else for my critiques of private equity, which I think is in part just because nobody critiques private equity because everybody loves it so much.
But I like their holiday parties. In Connecticut, the hedge fund parties suck.
Yep.
But the holiday parties in private equity for the last
Right,
decade?
it's a question of which rock star is going to be there for it. But I think to me that's the number one. I mean, private equity, private credit, the rise of this whole complex is I think the biggest gap between, especially what sophisticated institutional investors believe and what I think is actually true in the underlying data. And I think there's so many elements of that. I think one is, I think people initially went into private markets because they could find things they couldn't find in the public markets.
Yep.
They could find cheaper things, they could find mismanaged things. It was a really interesting sort of Wild West. And now when you look at it, what these private equity firms, they're creatures of the investment banks. They're buying what's for sale at auction, and they're buying it for sale at auction at higher prices than you'd pay for equivalent assets in public markets. So you say, okay, now I'm getting a much smaller company that I'm paying a much higher price for, and I'm putting a huge amount of debt on it, and this is somehow going to lead to more attractive returns. And I think the narrative as to why it's going to lead to more attractive returns, it's some mix of, hey, we're better at selecting companies, right? We're able to find these diamonds in a rough. And I say to that, well, but it's so competitive, right? If you're in an auction with 18 other PE firms, right, the price you're going to pay is a market price. So there's no inefficiency there. And then the big marketing thing is around operational improvements, that they're active, engaged owners, and that, David Swenson said it's a superior form of capitalism, and I think a lot of people have internalized that. It's better when you're an active owner, when you're sitting there aligning the incentives, and when you can get in and make changes at the company level. And what I've done a lot of work to show is that private equity isn't making particularly big changes, which shouldn't be that surprising, right? It's a bunch of investment bankers, right? I mean, how do all these investment bankers who spend all their lives investment banking suddenly become wizards at running like mid-cap industrial businesses, right? I mean, it just doesn't pass the smell test, and that they're doing that with 4 board meetings a year when their primary job is to do deals, right? I mean, walk me through how that's suddenly going to be massively better than what public companies, for example, are doing. And I think that you've just seen massive, massive amounts of money flood into this asset class. And I think a big part of that, right, I invest a lot in small cap, micro cap stocks. And I'll tell you, those micro cap stocks are volatile as all hell, right? And you can just feel like you are an absolute idiot on a pretty regular basis, either on a single name or on the entire strategy, right? Because you're just going to get whipped around. And I think when you look at private equity, the volatility of private equity is lower than that of corporate fixed income. And it's equities. So they're sitting there, and there doesn't appear to be any risk to anyone in the entire ecosystem. And I look at it and say these are highly levered micro caps that you bought for higher than S&P 500 prices with floating rate debt, and that's supposed to be less risky than corporate debt. And you should put 40% of your portfolio in it, which is now the new sort of institutional benchmark. It just seems totally insane to me.
I mean, if you were going to have their main competitive advantage, I'd argue, was very low and falling cost of capital and abundant access to capital.
Yep.
Now that's different than operational improvements. But if you're doing those two things at the same, if you have those two factors and you get an economic acceleration, you look brilliant.
Yeah.
Because anyone's operating activity is showing some acceleration anyway.
Right.
But from here, I mean, cost of capital to me is public enemy number one. Liquidity is a close second. So where do we go? I mean, most people on Wall Street fundamentally talk about the establishment, old Wall Street. You can see the Carlyle lobby all the way to Goldman Sachs. Cut interest rates.
Yep.
The next cycle is give me my bubbles back, give me my no cost of capital back. That I have my own views on whether or not that's coming back imminently or not. I think not. But what component of that cost of capital advantage do you think was there that?
Yeah, so I've been trying to coin a term, Keith, and it hasn't caught on, and the idea is fool's yield. And the idea of fool's yield.
Why isn't it caught on? It's going to catch on now.
Yeah, thanks, Keith. All right, you
Hashtag fool's
You're the
yield.
guy. But but the idea behind fool's yield is this. I think it's a universal truth about credit markets. Okay, and the way that credit markets work is that as your yield increases, your return goes up. If you start with like a AAA bond, and then you go to a AA bond, and then a single A bond, and your yield goes up, your total realized return goes up, and that continues about until BB, which is just outside of inside of high yield, just outside of investment grade. Your BB bonds have a higher yield than your BBB bonds, and you get a higher total return. And then what happens? The yields go up, and the returns go down.
Yep.
And they go down because the bankruptcy rates materialize, right? And so you might think, oh, gee, I've got this great 13% yielding bond. That's going to be a much better return than buying a 7% yielding bond. But in reality, you actually get worse returns in aggregate buying 13% yielding bonds than 7% yielding bonds. And what you've seen in private equity, right, is that private equity used to be funded out of the high yield market, right? This is Michael Milken's big invention, right? Get this junk debt, let the private equity firms use junk debt to do these LBOs, right? And that was true until the financial crisis. And after the financial crisis, the government said to the banks, gee, your lending at over 6 times EBITDA was bad, right? It ended in disaster. Just don't do it anymore. And this was, the early stages of the true private equity boom, when people were starting to pay not just 8 or 9 times EBITDA for companies, but 10, 11, 12, 13. And so they needed to have 6, 7, 8 turns of debt on these businesses. And so they needed a new source of financing. And what emerged was that a lot of these private equity firms had these debt arms. And those debt arms started to say, well, why don't we lend to fund these LBOs? And we'll lend at 7 or 8 times EBITDA. And we'll do it with these unitranche facilities that have really attractive yields, really attractive to the investors who are selling them to. And all of a sudden, now we can own the equity and the debt, and we'll grow a lot faster, and it'll be a really big growth area for the market. And so what you've seen is that over the past few years, private equity has shifted. Not many deals, or far fewer deals, are financed in the high yield market. The high yield market is actually shrinking or flat. All of the bad debt, all of the higher yielding debt, all the fool's yield debt has migrated into private credit. And what you've seen is that that's all floating rate debt. And they were doing deals at 8 or 9 times EBITDA, and there are all sorts of these adjustments, which are all bullshit, and pro formas and adjustments that are all bullshit. And I think KPMG did a study that said your actual numbers, your GAAP numbers, are 30% lower than your pro forma adjusted numbers.
Crazy.
Totally nuts. And so they borrowed a huge amount of debt, and all floating rate. And so I look at it now and say, how are those companies doing? Right? They've had a 500 basis point increase in their cost of financing in a year. And these firms, let's say you have 100 million of EBITDA, and now you have $50 million more interest cost, right? I mean, where do these companies come up with that? I mean, I just think it's a really difficult situation.
Well, it's mathematically impossible. I mean, if you take GDP down by 500 basis points and you take cost of capital up by 500 basis points, and that's the second part that I was going to ask you. I mean, as opposed to not just economic tailwind. Like, guys, if you show slide 13, the rate of change of GDP growth, very simple thing for people to understand. Pandemic, it goes to negative, as you can see there, almost negative 10. You get this acceleration with easy money, zero cost of capital, abundant or epic access to it, to 12.5% growth. Right? You're talking 2,000 plus 2,000 basis points of GDP growth. Then it comes down to 5. Now it's going to sub 1.
Yep.
The sub 1 part is what I'm really interested in. Because to me, using like your one-liner, investors should care about data as opposed to the myth. The myth is, 1, we're not going to have a recession. 2, it's going to be another one of those V-shaped recoveries. Because it's not a recession.
Yep.
Oh, but don't worry. If it is a recession, it's going to be a mild recession.
Yep.
And by the way, last time we had a mild recession, it was called 2001. You could barely see the recession. But you saw a profit recession like the country's never seen with a falling cost of capital.
Yep.
So now, what if we get a non-recovery or nothingness, which is, you can go back all the way to Reinhardt and Rogoff for anybody, and you can see that once you're strangled by debt, your long-term growth rate is systematically deprived and will be, just like anybody's demographic growth rate. So what if GDP just goes Japanese, in a sense, in that you stay inside of 1, you've lost 300, 400, 500 basis points of demand, and your cost of capital is up 400, 500, 600 basis points.
Yeah, I mean, I think that another way that you can think about it or look at it, and there are problems with this model, but a simple model of saying what's the earnings yield on the S&P 500 minus the 10-year Treasury yield, and you can think of that as the equity risk premium, and that has gone pretty sharply negative, right? I mean, and so this year, right, I mean, you look at what's happened, you've had a big increase in multiples, and you've had a big increase in rates, and so you look at that and you say, gee, what am I getting paid for to take some of these risks in public equities?
Right.
You then go to private equity and say, not only that, but I'm borrowing at 500 basis points over treasuries to fund that acquisition, and I was paying higher multiples because I was going especially into tech and healthcare tech as my big focus areas, and I think it's doubly problematic. But I think it's important to recall, I wrote this piece a few years ago about calling bubbles. And what I did is I looked through all the great investors, people we consider the great investors, and I looked at their letters in the mid-90s. And I said, when did they first start calling that the tech bubble was a bubble? And you had most of them in 95 and 96 saying that tech was a bubble, right? You had, I think Ray Dalio was probably the first because he's always the first. And then you had, Seth Klarman and Howard Marks and Druckenmiller and I mean, everybody was calling that this was a bubble in 95, 96, 97. And it went on for a few more years. And I think about the recent economic history. I think if you step back to 2019, you look at the set of financial conditions around sort of the end of 19, I would have said they were pretty bleak, right? I think you were at this high risk moment in some sense. And then all those companies got bailed out during the pandemic in such a massive way that anything stupid you did in 2018 and 19 ended up being kind of fine in 20 and 21 as a result of massive government stimulus and the huge shift to tech, which is where most of the insanity had been. And I think part of that is that people have learned, therefore, one or two bad lessons over the past few years. One of the bad lessons is to chase fads, because chasing fads works, right? Okay, crypto, AI, whatever it is, just get in on it, because that's where a lot of money is going to be made. And the second thing is, no matter how much risk you take, it's not going to matter. Just give it a few years, and either you're going to get bailed out or multiples are going to go up, right? And it's going to be fine. And I think you're seeing both of those things right now, where you're seeing this massive AI hype-fueled bubble, and I think you're seeing people take on a lot of FOMO chase. There's more of a risk of missing out on the rally than there is a risk of some downturn, because even if there is a downturn, it's going to be brief, and we're going to be right back to where we were before, or even better. We're going to have another 2021 where we can all mint money. And I think that's the psychology of what's going on. And I wrestle with it because I look at all of the signals that I look at and care about, and some of them are the ones that I've learned about from you, and things don't look particularly positive, and yet the equity markets are ripping. And I think there are other places like Japan where the equity markets are ripping and the fundamentals are ripping, and I get that, and that makes sense, and I love Japan for that reason. But in the U.S., things are harder to puzzle through.
Well, again, if I bring back that chart, I mean, the conditional factoring, David Salem and I talk about this all the time. It's about conditional factoring, conditional probabilities of an outcome that you can test every day.
Yeah.
Every day I can look at the Japanese economic data if they release it, and I can say, did the rate of change on a trending basis accelerate or decelerate? It's a very low bar because Japan rarely has accelerated.
Yes.
So, and everything is relative, and Buffett goes in and X amount of Japanese companies are trading below book. You get what we call quad one.
Yep.
Right? It's the best time to buy value. It's the best time to buy small cap because it's after you've left everything for dead and you don't think an economy can have an acceleration into quad one. Voila, there you go. So those are beautiful patterns, like fractal patterns, as I would kind of look at it. But the U.S., it's quite literally the opposite. You just want your bubbles back. But again, the conditional factoring was going from -9 to +12, and now going from 5 to 0 towards 1 or 0. It's just like, it's in a way, it's almost like watching like the biggest Ponzi scheme in world history. To me, like trying to get SPACs back, crypto back, hyper growth profitless tech back, Bitcoin sensitive equity baskets back. Goldman has a basket for everything that has no profitability in perpetuity, and that if you don't own it, you underperform this year.
Yep. One of my strategies we run that we had the misfortune of shorting some of that stuff, and holy smokes, did that blow our faces off. I mean, you look at this stuff and you'd say, okay, it's got some of the stuff that doesn't even have revenue, but negative profits, negative cash flow, And then we like to look at gross profit divided by assets, which is a very simple way of thinking of return on assets, right? If you can't generate return on gross profit for $1 assets, you're in a pretty bleak situation. So you're looking at stuff they're buying lots of assets or spending lots of money to grow assets, and then the assets they have aren't generating any gross profit. So not even any net income, but no gross profit, or very little. And that basket of things, the low profitability, high investment basket, has up 40, 50% this year.
Yeah, I mean, if you go down 80 or 90, you got to be up a heck of a lot more than that to get even close to break even. And there's that this year as well. I mean, I've not as forcefully always talked about cycle to date, but cycle to date is implicit in my process. There's a sine curve.
Yep.
Guys go to slide 5. It's like you're either coming down the sine curve or you're accelerating up the sine curve. So of course it doesn't end on a calendar date, but everyone in the establishment gets paid on a calendar date. So nobody wants to talk about last year to date, but they'll talk about this year to date. And if we're right next year to date, they don't want to talk about that next year to date either. But there's you will have, especially a younger guy like you. Like, I mean, you probably get chastised for not getting it.
Yep.
Like, I mean, you don't get blockchain. Like, you don't get blockchain at 68,000 BTC? What are you, fucking idiot? I mean, you went to Harvard. Like, how could you not understand this?
Yeah.
Using that as an example, or just substitute today every single thing that comes out of somebody's mouth on AI.
Yep.
I mean, it's like, I don't know what else to call it. You talk about bubbles, other than a bubble in behavior.
Yeah, and I think it's, there's a behavioral economist at Harvard, Andre Schleifer, who I talk to a lot. He's a really brilliant guy, and he's written about how we make predictions, how we make forecasts. And he's found that the same neural circuitry that underlines how we make forecasts is how we remember things. So basically, when we forecast things, most people are forecasting what they most recently remember.
Yep.
They're just saying that's what's going to happen over the next few years, exactly what I've experienced, right? And that underpins a lot of the behavioral biases, the availability bias, et cetera. But it's intrinsic to how our memory works. And so I think, to understand what's going on, you just have to understand, you just have to look back at the last 2 or 3 years, right? Mm-hmm. I think about my experience shorting some of these terrible, terrible companies this year, right? And I look back to conversations I had with Jim Chanos and others, in 2021, when they were saying, we've never seen more of these terrible frauds, and yet these frauds are ripping. Mm-hmm. Every day they go against us. And
part of the reason why I mean, at least in my process, I have a trade trend tail model that stops me out of that. So I will not believe what's in my mind or in my analyst's mind if it is signaling bullish trade and trend.
Yes.
Because I believe that Citadel, Millennium, Balyasny, their entire risk management system is built on that 1 month price momentum factor that doesn't matter if what the company does.
Yep.
That part I get.
Yep.
What I didn't get, and I still don't get, and this is getting into like a deeper part of the pool, maybe a deeper part of trouble for me, but the people that do get everything that I just said and you agreed with are starting to find ways to manipulate that through these short-term options, because you can create these gamma squeezes automatically. So let's just say I'm sitting on top of 100 Dan Rasmussens, who went to the best schools, who understand fundamental analysis better than everyone, and I know that 80 of them are short those pieces of shit, and they're all shorting them at the same time, incrementally into some event. I don't care. I hit a button, I have a basket for those stocks, and I just buy it.
Yep.
And then after they're all, 60 of them capitulate and cover, I sell it.
Yeah.
I mean, it's like a bloody casino. That's what you would do, because if you're using short-term options, it quite literally, like back to your point on the professor's point, you're tapping into these ODT options are by definition the most immediate recency bias you can find.
Yep. And you look at that, it's like the echoes of GameStop all over again, right?
Yeah. I mean, so how do you deal with that?
I don't know. I mean,
it's tough.
I think it's hard. I mean, I think you're facing a new set of market conditions that are really hard to deal with. And maybe you just look at it and say it's too hard, right? Let's go find somewhere easy.
Well, this is
easier,
actually
right?
Typically the response from the Twitterati,
Yep.
the newly bred, investor class of,
Yep.
Hey, dude, as long as it goes up, or whatever it is, I'll get that. If I had one answer that's kind of like cookie cutter,
Yep.
It's like, well, if you know that, why don't you just join the party?
Right.
So I mean, history does not look back kindly on that. So everyone wants to know when the music stops.
Right.
So how do you think? Do you think that short-term options could be regulated? Do you think that this is just going to go on and on and on? We're just going to make even shorter-term options?
Well, I think, as with most financial innovations, people participate until it really blows up, right? You need, right? I mean, you just need some salient event that teaches people that this thing was stupid, right? And whether that's zero-day options or private credit lending or sort of the crazy excesses of private equity today, right? You need a salient event,
Yep.
right? And I think you look at, Melvin Capital, right? And that blow-up was a salient event for hedge funds with regards to shorting, where I think a lot of them said, too hard, shouldn't do it anymore, right? This doesn't work right now, right? Well, what's the salient event for all the, zero-day options traders? What's the salient event for private equity or private credit, right? And when those events happen, right, you're looking at these things that have a risk of basically going to zero or dropping really sharply, right? They go up, and they're inflated by artificial reasons, and that can happen. But the end of that is a total crash, right? And I think you and I can both look at the fundamentals and look at the data and say something that's completely not supported by fundamentals will eventually crash and go to zero. Mm-hmm. The question is when.
Well, I mean, if you look back historically, and we just use a very basic example, which has now been completely discombobulated, which is front month VIX.
Yep.
I mean, you just look at historically. There's 3 phases to it. The VIX first move, January to June of 2022,
yep,
into the 30s, is when you realize the economy's slowing. Oh shit, company misses earnings. Oh, that company just lost $400 billion in market cap, and I own it.
Yep.
You remember that? That
yep.
happened. We're old enough to remember that. Your hair's not even gray yet. I mean, mine's going to go away next. Then part 2, okay, the Fed's going to come in.
Yep.
Remember, we're supposed to cut interest rates like 10 times at this point. And then we fail there. And then into phase 3, after the volatility goes down, because everyone says, hey, don't fight it.
Yep.
As you actually enter a recession, no matter how shallow or how deep, and the curve is inverted, then the VIX takes off so fast that you cannot, like it's the old adage, risk happens slowly then all at once. By my definition of where we're at economically, when you want to know when is now.
Yep.
But nobody believes that. Is anybody allowed to believe that?
No, I mean, I think
that runs money.
Yeah, no, it's just you've got to. I mean, it was the famous quote from the financial crisis, right? You got to keep going until the music stops, right? I mean, but that's the logic for everyone because you can't not keep up.
Yeah. How do you I don't spend a lot of time like kind of commiserating with friends about their year-to-date returns or anything like that, but like what would you say about the CYA type performance attributes or pressures embedded therein for people to, even if they know that the cliff is right there and their kids are going in a school bus right to the edge of it, that we got to keep playing the music?
Yep.
And full. Do you have a sense for that?
Yeah. Look, I think it's been a really interesting year. I mean, I think we have been somewhat insulated from it because we own a lot in Japan. We have a huge long Japan bet.
Great.
Which seemed so obvious in a sense, right? So you rewind to the last few years, right? So Japan, had peak corporate earnings like in 2017, and then 2018, the trade wars, and then COVID hit, and the Japanese decided that they're a very xenophobic country. Let's just close the borders until COVID is over. And they kept the borders closed till October of 22. And we looked at that and said, hey, look, there's a relatively obvious trade here because travel and tourism are 8% of GDP. They've basically ratcheted that down to not zero, but close brutally enough. Destroyed their travel and tourism industry. And in October of 22, they reopened it. They're going to turn it back on. So why don't we go buy everything that has to do with Japanese reopening? Let's go buy pachinko, let's go buy karaoke, let's go buy hot springs, let's go buy airline parts, let's go buy, you name it. And all this stuff is trading at, as everything in Japan does, but these bargain basement prices just absolutely nuked and left for dead. And I think what we've seen so far this year is just a massive rebound in those things. And it's interesting, unlike the US where the big moves have been because changes in multiple, in Japan, multiples barely changed because the earnings have been so improved. And they're going to keep improving. You look at the guidance in corporate Japan, it's up 30-40% year over year. And so I think once you kind of zoom out and you say, hey, look, everybody is so obsessed with the U.S. market, and it's 60% of global market cap, and I get it, and we're sitting here in the U.S., but I think if you zoom out, and you do this so excellently, of saying, hey, let's not focus on the SPY or the NASDAQ, right? Like, there's commodities, there's international markets, and the minute you kind of zoom out and see the possibilities, there are many more ways to get where you want to go. And I think if you're trying to get where you want to go in today's market, you want to find things that are going up. You want to find the things that are going up for the right reason that aren't going to actually explode in your face. And that's one of the reasons, I love Japan right now, right? You're buying stuff at 3-4 times EBITDA with higher dividend yields in the U.S. market, and a market that's gone absolutely nowhere for 20 or 30 years, right? I mean, that feels a lot safer to me, and that's the contrarian in me than something that's just been absolutely ripping.
It's when Warren Buffett, really tripled down and built Berkshire. These were the cash flow multiples he was buying.
Yep.
Into a 1980s economic acceleration. Now, I have no opinion that Japan's going to have any type of economic acceleration like that. Any economic acceleration is more to the point. But you've done a lot of work just kind of combining that thought on Japan. One of the best charts that I found here that you had to do with industry vol.
Yep.
And I didn't know what you owned, but you just rattled off a bunch of things that have a lot of cyclical vol from an industry perspective.
Yep.
Can you tell people why you didn't go with the safety trade in Japan and you bought, like on your own work even? And I think this is more U.S. You're ranking industry ranks on the income statement. Like he's basically looking at the volatility of the revenue and income stream. And passenger airlines are at the top, automobiles, hotels. You didn't say anything biotech in Japan. If you did, I wouldn't know what it was. But
they're semiconductors, though.
Yeah, they're semiconductor. Yeah. So can you go through like why you did it that way when you picked certain?
Yeah. So I think there's two. I want to respond to that in two ways. The first way, right, is you're saying it's quad one in Japan.
Yep.
And it's quad one in Japan, and in quad one, the junk stuff, the cyclical stuff, it rallies the most, right? That's where you want to be.
Yeah.
And I think a lot of people say, hey, I never want to own that. The Sharpe ratio of owning, consumer discretionary over a full cycle, or some of these volatile things is nowhere near as good as just owning safe stuff forever. But when things are blowing up, and if you can go in and buy things at the bottom, the stuff you want to buy is the small caps, the cyclical stuff. That's the stuff that's going to rally the most. And now I just live in that world, right? We invest a lot in micro caps. We invest a lot in cyclical industries. I just am in that cyclical sector of the market all the time, and I think a lot about when to size up or size down. But that's my sort of niche. It's the most contrarian, most exciting, to me at least, most fun part of the market. And so I saw that opportunity in Japan, and I said, let's go buy the most brutally beaten up crap that anyone out there is, everybody hates. And when the liquidity flows back, I often talk about like the liquidity is like liquidity works just like a beach, right? When the tide goes out, the deepest part of the water is barely affected, but the shallowest part is really effective. And when the tide comes back in, you're going to have massive increases in the percentage of water coverage on the very shallow parts of the beach, and not that much of a difference, right? So if you're going in and buying Toyota, you're not going to make as much money as if you go buy, Koshidaka Holdings or something, right? So I think it's just a very, very different, very different world. Now, I think, to this...
Koshidaka, everybody knows Koshidaka.
I do,
just like a video.
I do own
AI?
that, so I have to, yeah, exactly. So, anyway, but...
You don't have to be long AI to make money in Japan.
Yeah, exactly. No, you don't. You can be long hot springs facilities, karaoke joints. But I think, to this industry volatility, we've written a lot about the persistence and predictability of growth. And this was a big dispute I had earlier in my career, which is that everyone on Wall Street spends huge amounts of time building these DCF models, right? And if you think about the big input to the DCF models, what's going to happen to the income statement, right? And you get to these massively complex models, 12 tabs and 4 megabytes, right? I mean, I still, I think that my former colleagues and me a few years ago we must have been in like the top 0.01% of Excel power users. I mean, the things that we could make Excel do were truly unbelievable, maybe even sinful. And what I've realized and what I've done a lot of work on is looking at the predictability and persistence of growth at a company level. And what you'll find is that growth is neither persistent nor predictable. So all of these forecasts of like what's EBITDA going to be in 2028 are complete crap. That doesn't work. It's never worked. There's no evidence it's ever worked. Basically, there's just no predictability at the at the individual company level on an income statement multiple years into the future, right? Which is why I like your model a lot more. It's what's the short-term rate of change, right? What can we see happening over the next 3 months or 1 year that's changing, that's going to drive outcomes, not what's our view on 2030 revenue, right? Which is just a complete bunch of crap. And so I think you look at all of those models that are built on these DCF models that are built on forecasting income statement, and I think that's crazy, right? Why are you doing that? It's not supported by evidence. On the other hand, though, there's the question of the other part of the DCF model, which is what's your cost of capital? And I think your cost of capital should depend in part on the risk of the asset, and the risk of the asset should depend on the volatility of that cash flow stream. And so what I was looking at here with this analysis of industry volatility was to say, hey, we all divide the world up into sectors and industries: consumer discretionary, consumer staples, right? Are they real? Like, is there something about them that's persistent, or that we should actually understand or bet on? And what I did find is that actually, and this is not necessarily, I didn't know necessarily where it was going to end up, but these industries do have persistently different levels of volatility. Certain sectors are just persistently much more volatile than other sectors. And therefore, in my view, they should demand a higher cost of capital. And other sectors are much more stable, right? The difference between a utility stock and an auto parts manufacturer is really dramatic. And I think one of the sort of subtexts of why I was writing this is I was talking to a guy in PE and giving him my normal spiel in a very polite, diplomatic way, Keith, because I can't help but be polite and diplomatic. As I told him that his entire job was bullshit. I said, look, the levels of the valuation levels that you're paying and the levels of debt. I mean, these never end anywhere good, right? I mean, and he said, oh, but we invest in software. And I said, okay, tell me more. He said, well, software is the most stable industry, right? I mean, it's recurring revenue, right? And you pay a license fee, and so you get new subscribers, and they get on the license, and they never cancel, and so you can predict a software business. It's stable, and so part of me said, well, gee, why don't I? Or is that right? Let me go look at it. And software's right in the middle. I mean, software's not auto parts, right? Don't get me wrong. It's not the most volatile business, but it's in the 50th percentile or something. It's not like a utility. And I think part of my sort of reaction to that was, I don't think that's a good case for why you should lever up software businesses to 8 or 9 times EBITDA.
It's a new narrative.
Yep.
It's like anytime I see, or the best debates I get in, you try being me, I have to have these discussions with large institutional investors that pay us, and there's always a counterpoint to the cyclical point.
Yep.
Always. There's a talking point, there's a myth, there's a narrative. And because you can't prove it, they like to believe it.
Yep.
Because in their own mind, they need to believe it.
Yep.
Right? But if you just take the front end of rate of change, which is why I do that, to give you a conditional factoring on what the odds are of seeing some cyclicality in a business, you're right at the top of your list. An airline stock, the CNBC crowd will be loving Delta Airlines, reopening quarters. It's cheap based on peak revenue growth, they don't talk about that component of it. But again, they just are generally and fundamentally macro unaware in terms of their entire principal orientation, because there is none. Cheap stock, it's up.
Yep.
Right? That's the highest volatility sector of an income stream.
Yep.
I mean, it's amazing. I thought that's excellent. I mean, if you really just look at, if you backtest everything that ticks, every asset class, it all gets back down to that. Because the volatility of an asset class reflects the volatility of the revenue and income stream.
Exactly.
Therefore, the quads are the best way to front run those things.
Right. And I think the challenge you've seen is that a huge amount of inflowing capital, right? If people just keep buying and buying a certain sector or a certain trade, they can artificially reduce the volatility in some ways relative to the income statement, right? There can be this mismatch between a sector that just seems really smooth and really safe and the actual volatility that you're seeing in the financials. And to me, that's the recipe for a blow up, right? Because I think people, when people feel like something is the safest, when it's their flight to safety asset, that's the riskiest thing, because everybody agrees, right? And I think in markets, agreement is the most dangerous thing.
Well, we're going to get other people's questions, by the way, but I mean, we're old enough to remember, like literally everyone who tells me that about software right now, or AI in particular,
Yep.
told me that for all of the fourth quarter of 2021 about mega cap stocks.
Yep.
Keith, these are fortress business models. They are not going to show the cyclicality. I'm like, okay, GDP we have going from 5 to 2.5 to 1. Yep. You're telling me that Google's not going to see that. But you're still telling me on the same hand it deserves to be a mega cap because it is the economy.
Yep.
Yeah.
Right.
I mean, this is like colossal mistakes. People lost 40, 60, if they were long Ethereum or something crypto, 80 to 100% of their hard-earned capital believing that bullshit. And we're going to do it again.
Yep. Yeah.
Like, it's. I think it's fascinating. I mean, if you have questions, by the way, for Dan, pop them in the queue. There's already some that are starting to tick in here. But any other thoughts on that before I?
No, let's go to the questions.
It's like it's an amazing thing to watch people just go on and on and on with the give me my bubble back. Eli Nickel. Okay, this is a top voted question. If your questions aren't voted up, then you know why. Maybe not. Is the lack of a mark to market an asset? Is illiquidity not liquidity ideal for asset allocators because private market volatility? Because it's like laundering.
Yeah, the Cliff Asness, it's volatility laundering, right?
Is that what he calls it?
Yeah, it's a great line. But I call it there's a pension fund guy who said he calls it the phony happiness of private equity, which is again that private equity marks are less volatile than corporate fixed income.
Right.
And so if you're sitting there as a pension fund or an endowment manager and you put 40% of your assets into private equity, and generally what's also interesting is where they're taking that 40% from, right? If you think about just a very primitive level, right, the old default was 60-40, and then the endowment model, and again I'm dramatically oversimplifying, was let's take that 40 out of bonds because bonds stink, and let's put it into alternatives.
Yep.
And initially it was a mix of hedge funds, which actually are bond-like in some ways, right? They generally are risk managed and they have low volatility. And then when hedge funds went out of vogue, they shifted it into private equity. That's a big move in the 2010s. And so now you have 60% in public equities and 40% in private equities. And the private equity vol is offsetting your public equity vol. And that's become a standard institutional model, unfortunately. And I think what people don't realize is that the volatility on highly levered with floating rate debt micro caps that you paid more than the S&P 500 for is probably higher than the volatility of the S&P 500, right? Yep. And it's one thing, again, to own Facebook or Google or Microsoft, but if you're owning a $200 million in revenue business that trades at a higher multiple than Microsoft or Facebook or Amazon, right? Like, walk me through why you're doing that. And that's become such a massive portion of people's portfolios. And I think part of it has been that the consultants, et cetera, will say, well, gee, private equity never loses. You're always going to make more in the public markets. You're going to earn an illiquidity premium. And I say if you're paying an illiquidity premium, you're paying more to own private equity, whether that's in the fees, whether that's in the prices you're paying for assets, you should receive the opposite of an illiquidity premium, right? You should pay for your illiquidity. And I think that's likely the world that we exist in the 2020s. But we've had such huge inflows of money into private markets that's been able to sustain the entire business. And I just look at it now, it's cost of capital, it's rate of change, right? What's happened over the past year to the cost of capital for this entire asset class? And I think it's got to be bad.
Well, it's you don't get to the breakwater. It's back to the VIX versus the recession when you're actually in it.
Yep.
Like today, for example, or at least in the last couple of days, Blackstone, according to me, just made up their NAV on BREIT. And it's like, and this next question actually, he's not about BREIT, but I'll combine them. It's from Steve. It's like, Dan, isn't mark to market just a subjective number to begin with? I mean, it's like, how do you get away with that?
Yeah, well, I've offered my investors that my mom could price our NAV every month, but unfortunately, everybody seems to want the auditors to do it.
Yeah.
But with private equity, and I've built those valuation models, you say, oh, we've got 3 public comps, but that one's an outlier, so we'll scratch that one, or
we're down to 2.
Yeah, we're down to 2, and there's just a million degrees of freedom. But I think,
if one of your comps is Blackstone now, and Starwood Capital can say, well, look at their multiple,
right,
based on we should use that.
Right. There's this, that's a loop. But I think, I think though part of it comes back to human nature, right, and sort of your lived day-to-day experience, right. And markets, people have been writing about markets for hundreds of years, and one of the things they always write about with markets is that they're too volatile. It doesn't make sense, right? Why is the stock down 30 or up 30? It's never made sense, right? You go back to John Burr Williams in the 1920s, Harvard professor writing about it. He says, it's the problem is that experts aren't setting the prices, right? Whoever's trading on the stock market's just driving these prices. They must be a bunch of idiots. They just couldn't figure out why stock prices were so volatile. And so I think then you move into private markets and mark to model. It just makes more sense. Well, why does it make more sense? Well, an accountant did it, right? Well, accountants don't determine the stock price on the public markets, right? If everything just traded on book value all the time, right, then things would be a lot less volatile in public markets. But I think the reality of it is that volatility is intrinsic to markets.
I mean, it's that question should have said isn't mark to model.
Yeah.
Mark to model.
Yes.
I just read the question as it was, but like just the catalyst for that, because people are, I think. Most people, including the people that work in private equity, obviously, if they were having a discussion with somebody with their own God or something, they would agree.
Yep.
At some level.
Yep.
Not, there might be some spin on it, some marketing, there's compensation, reasons for that. But everyone wants to know when.
Yep.
Just like I said, when does the school bus keep going over the cliff? And why wouldn't when be? If the cost of capital, let's just stay with B-REIT because I like to pick on them because they're full of shit, like on this thing. Jonathan Gray, I don't need to go off on that anymore. But the fact of the matter is that unless it's different this time, the economic cycle is always the catalyst.
Yep.
And if you can't fund your redemption requests at yesterday's cost of capital, and tomorrow's cost of capital on the short end of the curve is going to be higher, and the economic growth rate is going to be lower, Jonathan Gray, what are we talking about?
Yeah.
How do we get to that?
Yeah.
Because that's never going to be asked on his conference call.
Yeah, I think this is a really tricky problem, right? I mean, you just say, look what's happened to your cost of capital. It's massively increased. And you're telling me that's had no impact? Right, or that you're up despite that, right? I mean, and I think if you look at the portfolio company level, right, the individual company level, right? These companies there's just no way they're cash flow positive, right? Mm-hmm. I gotta think the majority of them are cash flow negative with these interest costs. Yeah. And so you say, well, how long can that play out, right? How long can you be cash flow negative with a huge amount of debt on your balance sheet before you go into default?
Yeah.
Right? And I think that's something we haven't really seen. We haven't seen defaults, and partially the reason we haven't seen defaults in a long time is that we haven't had real interest rates, right? We've had zero interest rates. So like Japan, which has basically no bankruptcy, no defaults. Japan has no bankruptcy or defaults because no one in the system is motivated of a default, right? They're lending at zero anyway, so what do they care?
Well, that's the major difference.
Yep.
When people say to me, well, Japan's expensive now. In other words, I don't own it, or I didn't own it. But, America, I always say there's a unique nature to not only this uniquely American FOMO and chasing the fads and the MOMO, but there's also a unique nature to this. I asked you before you came in if you'd read this book, The End of Times, which is by Peter Turchin, and it's the elites, the counter-elites, and the path to political degeneration.
Yep.
People get really pissed off about this. Like when you and I both agree that Jonathan Gray can just make up whatever he wants and he's going to get paid on it, there's a significant amount of Americans that already get that trade.
Yep.
But if you and I were to go make up something on our income taxes,
right,
or running our business,
yep.
There are a significant percentage of you, and thank you for joining us, those that are watching for free, that would love to see me go to jail.
Right.
Yep. So what do you think about, I know that you still, you wrote this book, it's amazing that the waterfront that your career so far has traversed from. You wrote a book on slavery to all these different components, and you do not, from my perspective, write from a principle orientation of, that's the way it's going to be because that's Wall Street.
Yeah.
What do you think about that?
Yeah, I think this question of the elites. So I'm really into Phil Tetlock's work, and Phil Tetlock, did this huge amount of research on forecasting. and making predictions. One of his findings is that experts are no better than non-experts at making forecasts, even in the area they're specialized in.
Yep.
Right? And you apply that to Wall Street, right? Which of course it's direct application, right? The people that you think should know the most, that say they know the most, they actually don't know anything more than you know about the future generally. They're not actually using models that have predictive validity. They often haven't tested them. They're often these 5-year BS projections, right? And I think, to me, that has always bothered me, right? I've always said, I want to apply the science of forecasting. I want to look at, I don't want to just look, right, there's sort of the analysis, right? Like, what's the growth rate of this going to be? And then there's the meta-analysis of, like, generally how good have people been at knowing what the growth rate's going to be? And I think that sort of meta-analytic question has been one that's motivated a lot of my research and career.
Mm-hmm. I mean, there's no back-tested or empirical data to support that having a Bayesian inference process isn't better than a linear regression.
Yep.
But we have a society and an entire academic institution. The amount of interns that ask me, like, whenever we have a quick chat, like, why don't people do rate of change with a daily stochastic update? I'm like, because they don't get paid to.
Yep.
They're not going to turn around and say, hey, look, because Dan Rasmussen and Keith McCullough said that they should do it. I mean, it'd be like in some cases, I mean, I don't even know what that would mean. Yeah, but the bigger question here is, like, from a societal perspective, people know it's broken.
Yep.
You can make up whatever you want.
Yep.
And I'm not talking about elite like you. I'm not trying to, like, say, look, because you made money or you were successful. I'm talking about using your political capital to say things that are categorically inaccurate or not true or certainly not fair relative to what anyone else could have said.
Yep.
And when the shit hits the fan, who's going to be paying the bill on this next one?
Yeah, the taxpayers.
Right.
Right. Yeah, I mean, there was I don't know if you saw this New York Times article, but there was a New York Times article about who the wealthy are. Did you see that? Anyway, so the author was astonished because they went and said, who are the wealthy? And it turns out that the wealthy in America are generally people that own small businesses, right? Mm-hmm. Car dealerships, liquor distributors, they own a few buildings in their hometown, right? That's 95% of the people that's wealthy. And this New York Times reporter was almost upset. Like, I thought it was going to be all my buddies that work on Wall Street and the hotshot attorneys, and right. And I think that there's this mismatch between, was it Burke who said, don't mistake the noise of the crickets because you've got to remember that under in that grass are thousands of beautiful British bulls, right? And then those are the things that matter, right? It's not the ones that make all the noise, right? It's the silent cows that are dominating the landscape. Anyway, I'm butchering the quote, but the point is, I think that I think we mistake the chattering of the intelligentsia and their ability to get things done through manipulating language, whether that's manipulating the law or manipulating politics, with the broad, mass affluent people who have made money through honest hard work and through building their own businesses and just don't have time for that BS. Mm-hmm. But once you reach a certain point, the ability to game things through the political process, through crony capitalism, becomes so much more stretched. And I think people are really upset about that. It doesn't seem fair, and it's not fair.
Yeah, and I think you're seeing people go to people like you. Those people aren't, like, to your point, they're highly accomplished because they just grinded and built something that was real. So they get it. They get that they don't need to put, like, okay, hey, I got a deal for you. Let's take $200 million of what you've built in terms of your family office, and let's be the next one to be into BREIT.
Right.
Like,
yep.
No.
Yep.
It's all the poor bastards that they called and dialed up that came in at $25,000.
Yep.
They're stuck.
Yep.
And I'm finding more and more conversations like this, whether these Hedgeye live events or regional events that we do, they're the people that you're talking about.
Yep.
There's this great guy in Hedgeye Nation. He runs a business called Go Fan Yourself. But he built this great, like, industrial fan business.
Yep.
It's a great business.
And
he's like, I'm not dumb enough to put everything that we worked for into some 60-40 scheme or some private equity scheme this time. And I wonder, like, I do mean that. Like, I mean, we're running out of time here, but there is going to either be a significant bailout required for everything that you believe that has become private equity.
Yep.
Or there isn't.
Yep.
Going into an election.
Yep. Yeah, and I think that's a real point of commonality, Keith, and something I admire about you is it's this demystifying of finance, right? That actually the old wall, as you describe it, they don't know what they're talking about, right? And there's a lot of incentive in them trying to get you to think they do and that you don't, right? You as the individual don't understand it. It's too complicated. Yeah. And I think when you start to take Tetlock's insight, right, or a lot of your insights and say, right, most of the people you're talking to, the guy that owns the car dealership, is really smart and has much more than the average common sense, right? I think a lot of the intellectual class, they're very smart and have terrible common sense, and they make terrible misjudgments. Mm-hmm. And I think something like private equity is something that, the massive amounts of money that are being pushed into private equity, right, just doesn't make sense. And I think you hear it, a common sense judgment, you listen to what's happening, you say no. But you get into this hyper-intellectualized world of asset allocation and these categories and the trailing Sharpe ratio, and you come to these conclusions that no one with any common sense would make.
Well, the most common sense, and unfortunately we're going to have to end, maybe not with this point, but just the conversation in terms of the time's up. But a gentleman told me the other day, he owns 25 McDonald's, like if he built this, with his wife, and he's like, so I called my guy or whatever, and he said, I'm putting it all into the risk-free rate at 5%. He goes, I can't believe what kind of a European vacation I'm going to take my family with if that keeps happening every year. Do you think that can happen every year? Like, I don't have to keep up on anything. I just have to know that that's the new risk-free rate.
Yep.
That is going to change the game materially, and I think we're probably early on that if Powell's for real, but we'll have to see. Yep. I mean, if he stays with that, your work, I think, is going to become foundational in terms of like people saying, okay, well, who was actually calling this out early? So I just want to thank you for having the courage to do that. Being so data driven in doing that, because it's not just having an opinion; it's written mathematically, which is really important. And obviously for spending some time with me.
Yeah, it's my pleasure. Thank you, Keith.
Yeah, thanks. He's Dan Rasmussen. Now you know who he is, and I know a lot more about him. Thanks for joining us.